Today we'll be diving into the top 6 actions that Australian ETF investors should consider taking before the 30th of June to optimise their tax strategies and financial outcomes. I'm Money with Dan and I'm an experienced accountant that has been using ETFs for many years to invest for the future. First up, let's talk about reviewing your investment portfolio. Take a closer look at your ETF holdings. Are there any underperforming assets? Consider selling them to offset capital gains tax with your capital losses, a tactic known as tax selling. To help explain how tax selling works, let's look at a common scenario for ETFs. Let's say you bought 100 shares of the ETF called VGS when the price was $88.61. Today it's trading at $119.88. Meaning its value has increased by $3,127. Also, a few years ago, I also bought 100 shares of VAS when the price was $98.84. Since then, the share price has gone down to $83.34. While you could hold on to VAS in the hope that its share price will recover, you could also sell both VGS and VAS before 30 June to offset some of the gains from your sale of VGS. Doing so may not only soften the impact of the loss, but it could also be a good opportunity to shed an unprofitable stock and rebalance your investment portfolio. ShareSite's Unrealized CGT report can help you calculate how to offset your capital gains by displaying the CGT position for all your current holdings if you were to sell them on the date of the report. These are broken down into short-term capital gains, unrealized, long-term capital gains, unrealized, and capital losses, unrealized. The report also allows you to specify the sale allocation method at the overall portfolio and individual holding level to determine your optimal position, including first in, first out, last in, first out, maximize gain, minimize CGT. This method is more sophisticated than the minimised capital gain method because it considers the Australian CGT discounting rules. You can choose which allocation method to optimise your tax position best, and ShareSite then remembers this for future calculations. This is very handy if you are only selling a portion of a parcel of shares and not all of the investment. Tax loss selling can be a powerful tool to minimize your tax bill while optimizing your investment returns. But remember, you need to do this before 30 June. Next on the list is maximizing your allowable tax investment tax deductions to lower your assessable income from ETFs. The biggest tax deduction available for most people is contributing extra to your superannuation fund. By making additional contributions before 30 June, you may qualify for a tax deduction, reducing your taxable income and boosting your retirement savings. The tax deduction from making an eligible superannuation contribution can reduce the tax on income from ETFs or taxable capital gains. But remember, you need to do this before 30 June. Also, investors can claim a tax deduction for certain subscription expenses that are prepaid for the upcoming year. The ATO allows you to deduct the cost of subscription to share market information services and investment journals if they help you earn money from shares or bonds. This was confirmed in the ATO TD 2004/1. If you pay for your subscription in advance by 30 June, you can claim a tax deduction in this year's tax return rather than wait another 12 months to claim. For example, if you choose to pay for a subscription to ShareSite to help track your investments and prepare annual tax reports, the subscription fee for the upcoming 12-month period could be tax deductible in this year's tax return if you paid for it before 30 June. Don't forget to gather all necessary documentation to claim other deductions related to your investments. Moving on, let's talk about the capital gains tax discount. If you've held ETF investments for over 12 months, you may be eligible for a CGT discount of up to 50% on the taxable gain for individuals. Consider the timing of selling your ETF to take advantage of this discount and avoid selling investments you have held for less than 12 months, especially if they've made gains. Also, if you plan on selling your shares in May or June with big capital gains, consider delaying the sale until July if possible. By doing this, the capital gain will be taxed in the following year, delaying the payment of tax for an extra year. Timing your asset sales strategically can significantly reduce or delay your tax burden and enhance your investment returns. If you receive dividends from your ETF investments, pay attention to franking credits. These credits can reduce your tax liability, so understand how they work is essential for maximizing your after-tax returns. Franking credits can be a valuable component of your investment income, contributing to overall tax efficiency. Lastly, consider exploring the tax-effective investment options of different types of ETFs before you invest. Most tax problems can be avoided by choosing the right investment type and buying them in the right account name, such as the lower income earning spouse. Some ETFs earn higher franking credits on dividend income, while other ETFs focus on increasing share value over time and paying fewer dividends. Both strategies can reduce your tax in the long term. Thanks for watching, and don't forget to like, share, and subscribe for more tax tips for investors like this. See you in the next one.